Welcome to the panel of corporate development teams who are not from Asia. So I'm Mark Stevens. I'm a partner at Fenwick and done a lot of work in the game space. Full disclosure, one of my clients is Supercell, so Jaakko Harlas from Supercell is with us today. And I've agreed with the conference that I'll ask him all the hard questions, just to show that I'm not showing any favoritism. We have Sean Lee from Wargaming and Chris Petrovic from Zynga. Maybe each of you could spend just a second on, I think most of the companies are household names, but it'd be nice to know a little bit about you, your role, history, the 1 minute version. Sean?
Sure. As the non-Asian, I'll start first. So Wargaming, we're known for World of Tanks. We've been around actually 20 years, which is surprising for a lot of people. Started off in Belarus. We're based in Cyprus now. Started off in PC, in console and mobile now as well. Very aggressively looking for great ideas, great teams all around the world. Part of the reason why I'm here kind of speaking and sharing some of the thoughts I have here.
Hello everyone, I'm Jaakko Harlas from Supercell and heading our investments and M&A there. And of course, I guess Supercell as a company probably doesn't need a lot of introductions. But in terms of how we see investments and M&A, I think for us it's really a way of trying to make an even bigger impact in the world of games without increasing our headcount. And of course, in the past we've always tried to hire the best game developers into Helsinki, but it doesn't have to be like that. We also realize that through investment we can give talented game developers the resources and the environment to focus on what's their passion, so making games. So that's what we do.
Terrific. Thank you.
Chris Petrovic, I head up corporate strategy, M&A, and business development at Zynga. I've been there going on a year. Joined the same week as our new CEO and have been with him in the team since day one. Prior to that was at Kabam at a similar role where I had the pleasure of transacting with many of the Asian strategics that have been up here before on both the buy side and the sell side. As many of you know, Kabam recently got purchased, or at least its flagship studio, by a leading Korean company, Navarro. So I'm looking forward to letting you guys know a little bit more about what we're looking for and how we view the market from a investment and acquisition perspective.
And I'm excited in particular to see Chris here, to see Zynga back in the market. I think they were quiet for a while, so it's a welcome rejoining of the industry. So let's talk about the giant sucking sound coming from China. It was mentioned in the earlier panel. So many transactions are happening with Chinese buyers, and the Chinese buyers are not obvious buyers. One normally doesn't count chicken farming and molybdenum mining as backgrounds for gaming companies. But how much of that is hype and how much of that is reality, and is it changing your behavior in the marketplace? Do you just stop until they're done with the arbitrage?
I think it changes the behavior in the sense that when you see a company of a certain scale and profile, you automatically know that if they have sophisticated bankers of any sort, that they are aggressively shopping that target to Chinese buyers. The most recent example I can think of where we were engaged from just kind of an initial investigation perspective is Outfit 7, and you look at the financials of this company and the makeup of a 45-person studio in Central Europe, and 80% gross profit margins, et cetera, and the tongue-in-cheek answer to the banker was, we know where you're going, so we're not going to be able to compete. And lo and behold, the A-share company from China was the winner. I think we all are somewhat in awe of the opportunity that they get to use their funds to play that arbitrage game, because obviously inherently the value that they get, as you heard in the last panel, for those of you who are here, is much higher in the public markets than what Western companies get. I think it also changes our behavior in terms of the way in which we engage companies that we're interested in having discussions with about M&A, because we anchor on other components besides just sheer money. I know it's kind of a hard conversation to have, because for those of you that have stakeholders, including yourselves, that whether we want to admit it or not is a primary driver for most, if not all, entrepreneurs and their investors. So having the discussions around other elements besides just pure dollars. And keep in mind, these deals that come out of China are not without conditions. In many cases, there are heavily weighted on the back end, and there are longer time periods, and you also have the uncertainty of what happens to that money that's being held as the conditions in China change. So, we like to think that, from a Western company perspective, the transactions are a lot cleaner and more secure. And so that plays into the discussion as well, but it definitely has changed everybody's behavior in the marketplace. I believe, so far, 2 of the 4 largest acquisitions, Outfit 7 and then Playtika, have been from China, and then Netmarble, a Korean company with Kabam. So these guys are serious about creating that bridge between East and West, which is what we all aspire to in this industry, to create a truly global company. And I think that they're using their capital in such a way where they have that inherent advantage to do so.
Although I would argue Playtika is a slightly different situation, because you had a true strategic buyer. Bias. I also represent Giant. We did the Playtika transaction, and there may well have been arbitrage component to it, but it is different than some of the non-strategic financial money that is coming out of the non-gaming business.
Well, I mean, the ultimate goal of somebody like Giant is to be able to go back into the public markets with that under their belt, right? So it's not like they're going to stay private forever. So they're using this as a vehicle to get back into that. But you're right, they're not a comparable company by definition to a chicken farming company.
And Jaakko, actually, you having done a transaction just recently with what I would consider to be the leading strategic buyer in China, that acts a lot more like a international or a Western buyer, Tencent. Maybe you can comment on your view of them as a partner versus some of the other potential partners that are out there that are less strategic.
Yeah, I guess for us, it's first of all, I think it's a good thing that there's liquidity in the market. And on the other hand, it's a good thing that having these sort of alternative acquirers there means that we as strategics, we need to be able to bring something else to the table besides pure money, as Chris pointed out. So, and I think to all the sort of prospective target companies out there, definitely you should talk to as many people as possible and figure out who's the right partner. If it's the Chinese guys, then that's fine with us. But if it's Supercell, that's even better for us. And I wouldn't see it necessarily as a bad thing in the market.
So let's start with what kinds of companies you guys are looking to partner with, invest in, acquire. Is it a young team that is starting out, has an idea for a game? Is it an established franchise? Is it a technology tools company? What do you have a shopping list? And what stage and kind of what area might you be interested in having a deep conversation with?
Right. Well, from my perspective, wargaming, it's I have 2 views that represent the current view of wargaming. And my previous role before wargaming was actually doing something similar at Tencent. So if I was there, I would have bought you guys. But I think the perspective is very different. I mean, when I was at Tencent, you had almost abundant, unlimited resources to go out and basically take less risk but pay more. In the case of wargaming, we don't obviously have the balance sheet that Tencent does, so we try to go more for higher risk, higher return, earlier opportunities. In terms of the shopping list per se, we don't have a list per se, but we have shopping aisles that we like to go down, and those range from developers, projects with great ideas that we can back, technology platforms that are either core or ancillary to our businesses, whether it's AI or analytics, streaming, etc. Community is a big part of what we do as a free-to-play developer and publisher. So if there are companies out there who specialize in certain aspects of the community base, that's something we're interested in as well. I think from our perspective, publishing as a general organization is not something we're too keen on because we have that capability in-house. But I would say those are the general gaming ecosystem things that we'd like to look at.
Yeah, for us it's all about the people and the team. So Supercell was founded on the idea that the best people make the best games, and that's how we think about investments and M&A as well. So we're looking for great teams who want to make great games and who are ambitious, who want to have a big impact in the market.
And back-end technologies, are there useful things that you want to add to the platform in terms of analytics or is it all about game developers, or is it about the overall infrastructure? Because a lot of that you've built, but a lot of it you've brought in as well.
Yeah, I would say the focus is definitely on the game developers, but we are keeping our eyes open, and we're not sort of ruling out anything besides that as well.
And I'd be curious, what's a good addition to Zynga? Obviously, you've just done something in Helsinki, which I think people would like to hear about. But what else fits in the?
Yeah, I think what was just said about great teams making great product leads. I think peeling the onion back another layer beyond that. We look in categories where we currently operate. So, whether that's under our natural motion umbrella, which is more on the mid-core side, or whether that's under Zynga umbrella, which is more on the mass casual side, we look for pockets of opportunity to bring teams and products on that complement the portfolio and the genres that we currently play in. We also have a really healthy advertising component to our business, and so another way that we look at opportunities are folks that have created large audiences that can benefit from kind of the monetization capabilities that we have on that front. Geography is obviously another important thing for us. As you mentioned, we just started a Helsinki studio, which is a tremendous center of excellence that back from the Nokia days down to Supercell. And so we're excited about that. We're doubling down on this region. Obviously, we have the Natural Motion entity that's in the UK, and now we have a Helsinki studio, and so there's going to be more focus in this region. That's more of a kind of tactical approach in terms of diversifying cost across a wider base of studios. Obviously, the Bay Area is at the kind of premium end, and then we have a large studio presence in Bangalore, India, that's on the other end of the cost spectrum, and so to kind of create a good balance across that is important to us as well. But ultimately, and I'll say also, perhaps a little bit differently for a public company. And if my CFO was here, he would echo this, which is, we want to obviously make sure that as we put material dollars to work, that at a certain point, accretiveness becomes an important part of the equation, which is, the acquisition should on day one be additive to your financial profile as opposed to detracting from it. So, companies that are not profitable but at a large scale, become a little challenging. Companies at large scale that are at a lower profit margin than we are become a little challenging. So that's some of the more the pragmatic things that we think about as a public entity that may not play into private companies as much, but ultimately great teams and great product.
And that accretiveness, I think, is important. It's relevant to you. It's critical for the Chinese buyers. How important is profitability, current profitability, to Wargaming or Supercell? Is that part of the conversation, or?
We're very clear. We don't buy profits, so we're actually the abundance of kind of Chinese capital, whether it's strategic or not, doesn't affect our investment direction too much. In the sense of we're not buying profits, whereas a lot of them are buying profits. So for us, we feel less of a competition. The only time it becomes a competition is if we're interested in a company that happens to be profitable, that fits with our strategic needs, then we start competing with them with the Chinese money because they're buying profit. But as I said before, we're more interested in longer term investments that have a core alignment with our core products and services. And we have a much longer horizon in terms of when we expect that value to be generated.
I would also add that profitability should be a primary consideration for people running their businesses because that results in a better valuation, right? So the time to get that premium is not when you're unprofitable. So I think in terms of aligned interest, I think we all have aligned interest in terms of what we want to see in the marketplace. And to your point, I don't think very many of us outside of China go after things with the profit in mind first. But I think from a high level perspective, I think it's something that we all strive to see in each other, because ultimately that adds to better valuation, better outcomes, and et cetera.
So Jaakko in particular, it's public that Supercell has had some amazing levels of profitability, but obviously didn't start out that way. At what point, if you were looking at Supercell now, at what stage of your existence would you have done a deal? When would it have been attractive? Because clearly there's a point at which it would have become unattractive.
Yeah, of course, I guess the first angel investment would have been the best time to invest in us. But yeah, I guess I would echo what Sean said. So ultimately, it's the long-term potential and the potential impact that the target can have on Supercell that matters. So we do look at teams at all stages of the spectrum. So from early stage seed investments to companies that are already profitable. But of course, so echoing what Chris said here. So.
And I would also repeat the geography point. If you look back in the history of gaming acquisitions, EA created its regional studios around acquisitions. It bought a company in Vancouver and then built a 3,000-person organization around that. It bought a company in Sweden, in Stockholm, and then built a almost 1,000-person organization around that. Neither one of those companies were very substantial when they were purchased, but they were looking for not only the game that was held by the company initially, but also a management team that could, run a large studio. And it's one of the questions of what else might you be looking for, because the purchase price doesn't reflect the size of the studio that it became, but for the individuals involved, it was part of their career path that they wanted to run something that was that substantial, which is not what you get in a Chinese transaction, and we're unfairly characterizing that, but a financial buyer who is looking for something different than integration and strategic expansion. What about the stage of investments? I mean, when Zynga bought Natural Motion, they were not buying an early stage business. They were buying something that was already well established. Is that are you in? Do you have an appetite kind of across the range of stages, or what's the right kind of point for that conversation to happen?
Yeah, the short answer is yes. In large part because companies across the spectrum fit very, very distinct needs for themselves and for us. Since I've been at Zynga, we've announced one acquisition in the process of another, and those I would characterize as more kind of bolt-on acquisitions or category extensions in their earlier stage, but have amassed sizable audiences and shown kind of a profitability history. And the theory there is that you bring that into the fold, and then a parent such as us can unleash the full force of resources, both financial, technical, and commercial, and then allow the great teams to focus on making great product and remove the pain associated in this day and age with having to continue to try and scale. We know that the market is in such a state where companies that are reaching levels of success in terms of shipping product and seeing revenue are now being forced to go out into the market to raise money from folks like the panel that was here before. And the money is usually for something other than making great product. It's usually for marketing. And I think the financial investors would be hard pressed not to be honest about the fact that when they look at great game makers, they're not investing in them to level them up to become great marketers. There are already people that are great marketers. And so that creates a little bit of tension in terms of the investment landscape. And so from that perspective, acquirers can provide that toolbox. We call ourselves the Studio Support Center. We are the Studio Support Center. We serve at the pleasure of the studios and give them the resources that they need to be able to make their products, hopefully global hits. And so, those companies at that spectrum are great. For those of us that, including Zynga, that have been fortunate enough to, amass a decent amount of money that they can use toward deploying capital, we look at things that are of varying sizes that hit on different theses that we may have at the time around why we may want to make certain acquisitions. A lot of it is timing, where the company is in its life cycle. We're the tail end of the first year of new management, and they've been doing a lot of optimizing of the business, and so we haven't necessarily been as aggressive on larger things, but we're not afraid of looking at larger things because those can make material differences to our company and our shareholders. So it really just kind of also depends on when you catch us in our life cycle and what the particular focus is of the business at that time. But the whole spectrum is open for us, and we've been very aggressive at looking at hundreds of deals in the year that I've been here.
Sean, any thoughts on is there either stage or size that doesn't fit for you guys? Do you really want to capture it before it hits the curve?
Yeah, I think it depends on which segments it's going to be applied to. And what I mean by that is if we have an immediate need for, let's say, social analytics that's going to be crucial for our business starting right now, then we would be more willing to invest in or acquire companies that are more mature. However, I think wargaming, we have a very strong preference towards earlier stage opportunities and companies. And I think as a very private company, we do have a strong preference of building and building together. So we're a little bit more partial towards earlier opportunities where we have an opportunity to build together, although the risks are higher. But I think that's just where we are as a company at the moment.
And Jaakko, you're starting the program, I think, for Supercell. Is the if I've got a team of fabulous developers and we're working on a product, do I call you immediately when we're a year away from launch? Do I wait until I'm in beta and starting to do optimization? Do I wait until it's profitable? When do you want that call?
I think I guess overall the earlier the better. So for us it's all about the long term, and we want to build relationships for the long term with other developers as well. So it's good to start the conversation, and you don't know if something happens in the next month or the next year or in 2 years or 5 years, but it's good to make contact and just get to know each other as soon as possible.
So I'll second that on the relationship side. I think where it becomes a little bit tricky if you want to get into serious discussions around capital is that without a product and associated metrics, it's hard for these smart guys and the smart people around me in my company to do the analysis on how to actually place a tangible value on your entity. And then what you're left with is discussions around, comparable transactions in the market, what you've raised so far to date. Do your shareholders have to be paid back dollar for dollar? And then it gets a little bit more squishy, if you will, because you're not actually applying hard objective math. Whereas if you have a product in some meaningful beta, and even more optimally for somebody like me out in the market where we can actually see metrics, then you can start having the discussion and using hard math to kind of quantify the opportunity in its simplest form. But again, the relationship building early on so that we can start talking about your vision, how it aligns with our vision, and making sure that there's a meeting of the minds there, and then continuing to monitor how things progress is always a great stride.
I think just to add a little bit more color, it's always my experience has always been earlier is always better. However, I think it's very important to set the proper context and expectations when you start those dialogues, because if you set the wrong expectation or context, then there is a risk of you blowing that relationship at an early stage and being written off by the potential strategic partner or investor. So for you to manage those expectations, let it be known that, hey, we're pre-product or we're looking for this, and that's the context of the conversation. As long as that expectation is met, then you can keep on building that relationship over the months and years.
And there's a long-time phrase: the companies are bought, not sold. So is the time to start the relationship when a deal is at hand, or do you want to have known the team for longer than that? And what does that courtship look like with either a corp dev team or with one of your executives? Do they start with you to kind of help with the anatomy and the life cycle of a transaction?
Well, just take a quick stab on that. Our preference is always to do deals with people we know. We have a general, at Wargaming, we have a little bit of aversion towards random deals that pop up where we don't know the people, we don't know what they do, we don't know their story, we don't know what their families look like. And so from that perspective, we've always been partial towards deals and opportunities where we know them. If we know them intimately, that's even better. And that's why I think, echoing the previous kind of question, the earlier the relationships form, the earlier that foundational kind of understanding is set, I think it sets you up for better opportunities down the road.
Jaakko, you want to comment on that?
Yeah, I would agree. I think it's always somewhat jarring when the first engagement with a company is through a banker or advisor that's helping them run the process. Because the initial presumption out of the gate is that they're running a process for a reason. And again, the next step in your mind is that reason is not necessarily a good one. Although there are plenty of acquisitions that have happened recently where folks have just come to a natural cadence or part of the life cycle of their company where they're just ready to move on, and they've gotten their company to a good place. And in that situation, perfectly makes sense. And I would urge all of you in this industry that, as you are thinking about this, please do consider the important role that advisors play, whether legal, business, or otherwise. I've seen all too many instances where the target business gets affected by just the sheer amount of bandwidth that it takes as an entrepreneur, as a leader of a company, to participate in the process. And it's not anything malicious that the buying company is doing. Due diligence can be a bitch, especially when you're talking to a big company that has resources versus a small studio that has limited resources in-house, at least, to do those things. And what happens during that process, which can take is, there are deals that are done in weeks, there are deals that take many, many months. The longer it drags out, the more variables come into the mix, the more you're not keeping an eye on the business, and the business falls off, which affects the transaction price. So just from a bit of advice, as you're thinking about these things, and even if you end up not going through it, I think there's a lot of value in surrounding yourself with advisors who do this for a living that can provide you with the correct guidance and eventually take a lot of that burden off of you so that you can focus on running the business, because ultimately that's the most important aspect of the equation.
And to stitch some of these pieces together, we hear, talk to us as early as possible, but have metrics so that we can value you. The only way that makes sense is that this is a long conversation. This is a conversation that begins relatively early on in your product and company life, where you become familiar with the teams at the potential buyers, and years can then go by during which you keep them updated. Your friends in the industry, and then you have a ripe situation to call them up and say, "Hey, the game's going great," and somebody else approached us. We'd rather be part of the wargaming team. Can we chat? That is a well set up, I would say, structure, as opposed to we need to sell ourselves, hire a bank, and the bank calls the 10 biggest companies in the gaming industry. So there are the right and the wrong ways of doing this. Unfortunately, if you've been doing it the wrong way, it's too late to start the right way and have something happen in the near term.
I want to say one more thing. We are not adverse to taking inbound emails or calls, whether through introductions or otherwise. I mean, that's why we're here. We have teams around us that also, whether it's through LinkedIn, whether it's through email, like our job is to take in communication and establish those relationships. The other piece of advice that I would give is don't fall into the trap of casting the net uniformly and widely. And maybe this is just a personal pet peeve of mine, but nothing will get me to delete an email or a LinkedIn note quicker than when it's clear to me that the person has done either a form note, especially when somebody else's name shows up somewhere in there. It's pretty clear.
That's a bad thing.
But even beyond that, just if you've identified a company you want to reach out to, do some research, understand as best you can. I know for private companies it's a little bit harder because they don't disclose as much publicly, but through this industry, you can get to know the companies, their strategies, where their interests are. You can read press releases, you can read news stories, you can talk to friends in the industry. When I get a pitch about something that is not anywhere near what we've talked about publicly as being in our sphere of interest, I know that the person has not taken the time to get to know us. And so, I'm not going to necessarily take the time to get to know them. I mean, we get, in a 30-day period over a given month, we get multiple inbounds a day through our team. So we look at 60 to 100 deals at various stages per month. So we need to, and we have a pretty thick no filter even after kind of engaging. So please, I would say, take the time to research the companies that you're reaching out to and understand a little bit about them, or as much as you can, and have that inform your outreach and provide the proper context for how you're framing up who you are, what you do, what your team is about, what products you're making, and how you see it as a potential fit for any or all of us.
So let's talk a little bit about deal structure and what you would be willing to do. We've talked, I think, in the context of outright acquisition, but what about the dating before you get married? Is there a minority investment with a strategic relationship of some kind that is possible? Is it preferable? Are you willing to take a majority position, kind of the Netmarble, Jam City kind of structure? What deal type makes sense?
Maybe I can start on this. So I think we are pretty much agnostic on the structure. So really depends on the situation of the company, the objectives of the shareholders, what they want to achieve through the transaction. And I think there's also a lot more, many other factors beyond just the pure economic structure of the deal that matters. So how do you structure control on the things that really matter, creative control, your studio location? Are you able to maintain your culture intact? Are you able to keep your people in there? So there's a lot beyond just pure percentages, and I think those are the ones that become really important in the end.
Yeah, I think I share the view that Jaakko shared. I think it may partially be due to the fact that we tend to be quite private in terms of how we're structured ourselves, which gives us a lot of flexibility in terms of we can really do whatever deal that needs to be done to make that deal happen. It goes anywhere from just a personal check for a loan to convertible notes to whatever derivative options. If you want to go down that path, we're happy to do that, because ultimately we feel it's the relationship and the foundation you're trying to lay through the deal term that's going to be the starting point upon which you're going to be building something together. So for us, it's just a homework. It's something we need to do. It's a hurdle we need to get over in different ways to get over that hurdle. And that's our view. In terms of your question around majority, minority, whatnot, I think just in line with our views on a longer-term perspective on building things together, we have a bit more preference towards minority stakes, where we hope the founders are still largely self-motivated and incentivized to build the business on their own. And we can help and aid along that process. But once again, that's kind of our investment philosophy. I think other companies and other organizations have different views on this.
So you have two votes here I'm interested in hearing Chris, because you have a different perspective. My guess is for minority stakes, living with the company for extended period, and then potentially growing into more, as opposed to jumping directly to we need to own it as a model.
So I would say, philosophically, I would agree with what was said in terms of we're agnostic, and we'll have discussions along the entire spectrum. The reality is, if you look at our particular track record, it's been very heavily weighted toward outright acquisition, and in fact, a lot of the largest franchises and the most innovation that has been infused into our company over time has been through acquisitions. And so there's just been a historical appeal that acquisitions hold for our company. We don't have a formal framework for investing. We don't have an investment arm, so anything that we would do there would be somewhat not the norm for us, and it would have to make complete sense. We'd have to thread the needle very carefully with the target company on why it makes sense to do a minority investment. so we don't have any history of doing that. I've been exploring a lot more recently the notion of kind of the majority, kind of 51% interest. And the reason why that interests me is because if you think about the reasons why somebody would do those, at least from a Western company perspective, one of the main ones is to be able to tap into the expertise and market leadership of a company that is in a geography where you currently do not operate, or don't have a strong presence in, whether that's Asia, whether that's Latin America, whether that's the Middle East, any one of those regions where a historically Western-facing company does not yet have a presence. That structure is appealing to me philosophically because it allows for there to be some kind of liquidity event for the owners and the shareholders. It allows for them to still have a certain degree of operational autonomy, subject to kind of how you structure the terms of the deal, and allows us the benefit of kind of putting real skin in the game to really prove to the market and to the company that we are in this together. The challenge there, obviously, is you have to almost consummate two transactions at once in advance, right? So you kind of...
I was just wondering about that because those deals are seductive, but really hard.
Really hard. I mean, so what I mean by that is, so you're doing the first deal for whatever the percentage is, and then in many cases you're also structuring how the remaining percentages gets acquired upon certain benchmarks or deliverables being achieved, and so you're kind of doing two deals and trying to wrap them into one, and a lot of things can happen between now and then. No different, I suppose, than earnouts, or which are kind of a derivation of that in the sense that you have kind of payment over time based on hitting certain marks. So we are open to all of them. It just kind of all depends on what are the needs of the organization, and we aren't currently looking to publish games from external studios on a commercial basis. So that kind of investment plus commercial relationship is not in our wheelhouse, and I would even argue that if a strategic is investing in you, that your financial investors, to the extent you have any, would probably want you to steer away from a commercial relationship at that stage to preserve optionality and not create conflicts that would inherently come up around how to handle your business.
So Jaakko, you've actually lived in a company that was 51% owned by a major Asian strategic with the SoftBank transaction. How did that? Do you think that is a good structure for the autonomy and the incentive base for the team?
Yeah, I think at least for us it worked very well. So it all comes down to, as Chris said, how you structure the other components of the deal. So the creative control, operational independence. If you manage to get those things right, then it can be a very good model. And I think the structure we have now with Tencent is very similar. So they, their group owns the majority of the economic control, but we still, I would say, we probably have even more control over our business than we had with SoftBank. So I think it was a great deal for us.
There are some. If you think about doing it in a long-term basis, though, one of the drawbacks is that you can't integrate. So you're making a long-term commitment to being a standalone business, and is that going to be the right answer for a majority of deals, or would you how can if you're a company trying to figure out what the life looks like going forward, how do you decide whether you need to own the whole thing or whether you need to whether a majority is okay?
I think it's one of those things where you kind of know it when you see it, and it's hard to really provide a stock list of attributes for a particular deal. I think I alluded to earlier, one of the things that I've been looking at more is kind of majority ownership structures. And again, similar, I would say, in spirit to what is happening with Tencent and Supercell, which is Tencent very, very adept at their market, Supercell very adept at its markets, and to the extent that there's areas where they can help each other. Great. I know Tencent has bought a material amount of shares from Glue, trying to get a game published in the West and using Glue's platform for that. So for me, looking at those kind of deals where we're looking at companies in other geographies where we have little to no penetration and no expertise, I would tend to want to leave that company alone to continue doing what it's doing in its market, and then provide them with not necessarily integration in terms of being part of our systems, but provide them with our expertise around monetization, the ad platform that we have, the relationships we have with the platform partners, the scale that we have, the resources that a big company can provide, short of kind of full-on integration, because that, to your point, is probably the last step in merging the two companies that is predicated upon a full acquisition. But there are strategic can unlock resources in a way that makes sense and doesn't cannibalize their own business or doesn't compete with it, because we see opportunities where both sides can be value add to each other.
I think just to add to that, at risk of sounding fluffy, I think the chemistry between the relationship really is what defines that, as opposed to specific ownership structure or percentages. But I think we've seen too many cases where a wholly owned company has a horrible relationship with the mother company,
right,
or vice versa, where it's a minority relationship, but they're tighter than even intra-departmental relationships, right? So I think it's kind of what Chris was alluding to is that relationship and the chemistry that Tencent has with Supercell or we have with some other entity that we have. I think that really defines what the relationship looks like.
So let's talk about the role of VCs in your deal making. Would you partner in this kind of 51-49 relationship if one of the remaining shareholders was a VC? Is that an ideal structure? Is it suboptimal? Would you co-invest with a VC? There's a little bit of a love-hate relationship between VCs and strategics.
It's funny. I think it only goes one way. I don't think. Well, I can talk more about that later.
Okay. Yeah. I just briefly. I mean, we have. I think it all depends on the VC as well. I mean, for example, Wargaming is an LP in London Venture Partners, who was speaking earlier. We generally enjoy communicating with VCs in terms of sharing deal flows and kind of cross-checking opportunities and whatnot. That perspective is nice. I think the challenge from us is, as I said a couple times, we have a very long-term horizon in terms of how we look at investments. And so that tends to conflict a bit with VCs who have a more definite and fixed investment horizon, and they need to get out of it in a certain kind of way. So our preference is, I don't want to say avoid, but we prefer cleaner slates when we're looking at deals. If there's a VC in there, then we'll figure out a way if it's a very, 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 very compelling opportunity. But I think as a company, given our investment horizon and the collaborative relationship we're looking for, we view them more as a industry peer sounding resources as opposed to co-partners in multiple deals.
Yeah, I think Sean summarized it pretty well. So I think we're on the same line. So with the right VCs, if the opportunity is compelling, I don't see a reason why we couldn't do it. But as Sean said, it always adds complexity to the transaction.
I love the VC community because they are without them, many of the companies that we end up talking to wouldn't exist because they wouldn't have gotten the early funding. I think they're also, as I mentioned earlier, about surrounding yourself with great advisors to take the burden off of yourself and having to focus on the interaction with strategics such as us at a time when you want to be focusing on your business. They're great for that. They're also great, as Sean alluded to, in terms of deal flow. The part of the relationship environment involves not only folks like myself and my team communicating with company leaders, but also their investors. And so, my team and I spend an equal measure of time meeting with investors and venture capitalists, both in the States and around the world as we travel, to get to know their portfolio, to get their perspective on the business, which in many cases is a nuanced, different perspective than what you might hear from the founders, but equally as valuable. And also just getting to know where their heads are at as a financial stakeholder. It's just great to set those expectations, like you said, early on, whether it's directly from the company or through their main investors and board members. So, I was joking about the one-way love-hate. I think the VCs probably have a little more angst around strategics when they get involved in earlier stage investing because of the potential to set up for conflicts, as I mentioned, if deals are not structured properly. But there's certainly nothing but love in the other direction.
They certainly love it when you come in and buy them out. But that's a different kind of conversation.
Conditional love, yeah.
That's right. So I'm going to have one more question for the panel, but then open it up for questions in the audience to maybe start thinking about things you may ask the August group up here. So pull out your crystal ball, and are we going into, there have been a number of very large transactions in the last 12 to 18 months in the gaming space, some of whom are up here. Are we going into continued consolidation, or do we have, are there always new companies, and when the more mature companies get bought, there's the new sprouts come up, and there's always new innovation. Any feel for?
Well, my observation has been, I think those two always coexist. It's just a matter of what's happening more, right? So I think from the two, I see a definite consolidation trend among the known world, which is whether it's PC or console or mobile or free to play, certain segments that are established and known. I think there's a lot of consolidation going on within those areas. And as consolidation happens, there's always going to be offsprings of that's going to stem new things and whatnot. But I think I see a broad trend towards consolidation. What I mean by the known world is that there are the unknown worlds, whether it's too known, but AR, VR, mixed reality, other forms of entertainment, whether it's spectating or interactive, narrative experiences, whatnot. I think those are areas where you're still going to see massive fragmentation, flooding of startups and new teams that are trying to go after those kind of the wild west areas. So that's how I distinguish between the known worlds and the unknown worlds.
Mm-hmm. Yeah.
Yeah, I don't think I have a lot of sort of insight on that. I think it's going to be fairly lumpy. So there will be, continue to be opportunities from time to time, but I think it's very hard to say if it's a trend of increasing consolidation or fewer opportunities. I'm talking mainly about the mobile world. So
yeah, to follow on that, I'll add maybe a little bit more of a kind of brutally honest term on top of consolidation. I think it's consolidation and attrition, unfortunately, that's happening. I think we are, and I like historical analogies whenever I speak about our industry, but if you take the timeline since the first version of the App Store was launched 9-10 years ago, and see how far our industry has come in that short a period of time, and compare that to the console industry, which took over 20 years for that same level of kind of consolidation to happen. And obviously, the growth curve of mobile devices versus console devices kind of was the harbinger of where we were going, right? That hockey stick and eventual leveling out. When the App Store first launched up until I'd say late 2012, early 2013 was what I call the Renaissance period, where it was very democratic. It was very low barriers to entry, low cost. Anybody could get in. The independent games thrived, and then as consumers' taste got more sophisticated, as more venture investment went into the market, as hardware and technology and operating systems got more sophisticated, those things led to a fast, rapid maturation. And from 2013 till today, we've been in what I call the phase 2, which is industrial revolution phase, which has kind of unfortunately created this broadening delta between, as they said, industrial revolution, the haves and the have-nots, right?
The economies of scale or not. It's hard as a small company to come in. The top 10 has not moved much in the last several years.
That's right. So I think that just, and again, what that's led to is really great studios having to go out there and create great product with the money they have, and then having to go back into the market to ask for money to market it, which again, as I mentioned earlier, creates tension with financial advisors, with financial investors. And so I think there will be that continued attrition. I've seen a lot more what I'll put in the category of kind of acqui-hires as a mechanism for bringing companies into the fold. But yeah, we see it in ad tech, we see it on the developer side, we see it across the entire chain. I mean, just as a proxy, when was the last time you saw any kind of large-scale pure play acquisition in the console space? Right, it doesn't happen anymore because
it's kind of a silly concept.
Yeah, right. It is, and so I think that's we're quickly getting to that phase, but we do have other creative outlets through other types of development for AR and VR, different business models in mobile. We still have half of the world, broadly speaking, that doesn't yet have a device, so there's not that full penetration yet. But the downside is that those territories where devices aren't yet persistent, there's not the level of monetization yet present either. But hopefully, countries like India, which I firmly believe are the next China in 3 to 5 years, because they're showing all the signs of that, are great new opportunities. So there is still pockets of opportunity in our industry that'll take us in for the next several years. But I think the stage has already been set for the most part in terms of the great folks like Supercell and others that have kind of gotten that leadership position and are equivalent of the EAs and Activisions of the world.
Okay. Any
Maybe
questions?
Mark, one final point to add to that. So I guess when we're dealing with creative talent, like people who are game developers, so I don't see a lot of economies of scale there necessarily. So if you roll up 10, 100-person studios, it doesn't mean that you necessarily have a better chance to get that next top 10 grossing hit. So
that's absolutely true. Question in the front.
So I kind of wondered if there's like a kind of an insider story to why you guys decided to invest more outside. Like, it seems like you accumulated capital for a long time. You had a lot of money, and you did have a change in ownership. And after the change in ownership, now you seem a lot more active, looking outward, I guess. So is there some story to that? And basically, does everybody on the panel have that story about transitioning from inward looking to outward looking as far as investing goes?
Good question.
If you promise not to tell our development teams? That's a really good question. It's a sensitive question. I think my politically correct answer is it's not less of an emphasis on internal efforts per se, but I think at least for wargaming, as we mature as a company and we go through cycles of confidence and not having confidence, I think we've come to a realization that, hey, we're not the only smart guys on the block. We've kind of come to a moment of humility and maturation where we realize that there are lots and lots and lots of really talented people with great ideas and technologies all over the world. And so through that realization, we've been making more and more efforts to try to scan that landscape and identify teams and opportunities that may have a good fit with what we're trying to do.
yeah, so I think along the same lines as Sean said, so I think we realized as well that, okay, hey, we have some great talent in Helsinki right now, but they are not the only talented game developers out there. So I think investing in M&A, it's a way for us to really support great game developers in other parts of the world and hopefully enable them to make great games in an environment where they can really focus on their passion.
And what I'm seeing is that in the tech industry, has been a trend of the larger companies that have been cutting back and using venture-backed startup companies or angel-backed startup companies as their R&D lab, and they kind of need them out there. The story is that's kind of how Cisco operates, is that there's a lot of innovation going on, and they'll find out what's successful, and then they buy it. I think that it's not a shortage of internal opportunities, it's an excess of money. I mean, you have cash that can fund other opportunities, and the ones that are internal that are promising are being supported. It's just that the company can support more of those. That's my view of how the very successful private companies are operating. It's probably different in the public environment. Another question? Yes.
A question for the panel. To what extent is a company being part of a formal sales process a negative for you? And any do's and don'ts you have to recommend companies that might be considering being part of a formal sales process?
Yeah, I think I touched on that a little bit earlier, but to put a finer point on it, and this just is more maybe my personal kind of approach to it, but on the axiom that great companies get bought, not sold, I think that holds true, but there's also obviously a lot of exceptions. There are personal reasons for each individual company that chooses to go through a process of why they are going through a process. You're going to have to, in many cases, get over the hump or the general kind of reticence on the other side of, hey, there's a reason why they're going through a process, and it may not all be good. And even when we know that to be the case, kind of we see it, we feel it. The folks on the other side of the table, advisors included, and they paint the picture as best they can. But again, we've seen many transactions happen. I think Social Point was mentioned earlier. I mean, great company. went through a pretty exhaustive process that started in December of 15, as was said, and they've been a long-time games company that just chose to go through a process, either A, because they get inbound interest, or B, because they want to take their company to the next level, or C, because the founders have other things that they want to go do, or D, they get pressure from the investors to get a return, or E, something else. So again, there's a lot of different reasons, but kicking off a process puts up the radar of buyers, and you kind of have to, almost, it's guilty till proven innocent, as opposed to the reverse, if you will. But again, with a solid company, that's easily broken through, and then you kind of move forward from that and get to the business at hand.
Yeah, not much to add there. So it really comes down to understanding the motivation behind the sale process and understanding the long-term motivation of the founders and employees.
I have a more simple answer. We're just pretty averse to processes. As a former investment banker myself, it's hard for me to say this, but limited value add in a lot of cases. I hope you're not a banker or an advisor, but it's just reflecting on my experience. That said, there are great people, some in this room, who are excellent advisors who can walk you through this process in a really nice way, who have credibility with both the buy side and the sell side. But if you're just knocking on some accounting firm down the road to help you with this process, you do walk in guilty until proven innocent, almost.
I would say two things on that. One is there are very, very good buyers who refuse to engage in processes. So Bobby Kotick, for example, has stated on the record many times that companies in a process should wait until after the process is done to give him a call. He's one of the smartest buyers in the industry, and I think that is you do lose a portion of your potential buyers. Also, if the process assumes that you can call somebody who hasn't met you yet, you better have very, very solid numbers that are exactly what they're looking for. That find the fit for a stranger is more difficult. If the process is you want to help, the bank wants to help you find the best valuation and the best partner, and you have three partners that you have a relationship with, and the bank is an intermediary in that to help you negotiate, that's a completely different kind of situation. If the bank is doing a book and mailing it out to 30 different destinations, it's a hard deal to get done in the games space, in my experience. Thank you to the panel for the great comments.